advisor and for the consumer as products start to change in shape. And you're going to see lots of increases in premium rates, in particularly income protection, which is going to cause advisors to actually have to go back to their customers a lot more. That's going to increase the cost of advice. In addition, coming into the industry, and I think Brad's point is very fair, it is very expensive to set up a practice. Right? It's very capital intensive, and the reason institutions don't do it is because it is too capital intensive. It's actually left to individuals to do it, and I think those things have to be taken into account in this debate as well.
Well, you raise an interesting point there, Simon, and one of the things we published recently, for all those who read your money managements every week, as you should, was the findings of the research from Investment Trends that suggests that actually life risk sales are now a far greater proportion of the income stream of an average financial planning practice than has ever been the case before. Now, that may or may not be a good thing, but from your point of view, do you think it's a healthy manifestation that, I guess, there was a stage in the financial planning industry where lifeys were somewhat derided, and now some of those who were deriding them are getting into the sales aspect of it because, frankly, they need the dough?
I would describe it this way. I think the industry set standards of mediocrity you could only dream of in the 90s, in the sense that everyone got excited about superannuation and invested heavily in superannuation at the same time as you had the introduction of income protection insurance and trauma insurance. So the industry effectively underinvested in itself as it got excited about superannuation. I think you're now seeing the numbers in superannuation, particularly discretionary flows, dry up, and you're now seeing capital move towards life insurance in a wider sense. I still don't believe we've addressed the legacy issues of the past at all, but to me that's what's driving it. So it's only catching up from a very poor position in the first place is how I'd describe it.
Well, Simon Harris, you're on the front line somewhat in the advisor space. How are you seeing it?
Well, I think Scott made a good point. He said that good salespeople understand their customers, and I think what's forgotten in this argument is when we're thinking about divvying up the value chain and pushing profit up one end or the other, that life companies need advisors more than advisors need life companies. So I think the balance of power needs to make sure that the value chain is shared evenly. What are we seeing with advisors? That the business is changing so rapidly. Regulatory change is forcing significant change for them, and this is just adding to the angst that they've got. So we just need to make sure that we consistently talk to advisors, find out what their needs are, because they're much closer to clients than life companies and dealer groups can ever be.
Don Trappel?
Sorry. Sorry.
No, you go, John.
Well, life companies need advisors more than advisors need life companies. We need each other. I don't think we can take a view that one's got an upper hand on the other. I don't think we're a partnership, and if we're not a good partnership, as Scott talked about earlier, the non-advised channels will just drive through us like a truck.
Good point, John. I agree. There should be a partnership.
Don Trappel?
The flight to risk that we've seen since FOFA started tinkering away with our careers hasn't been a bad thing. We've got an underinsurance problem in Australia, but that underinsurance problem is not going to get any better if we can't encourage new players to come into the market. It's new advisors. My balance sheet of my retail operation, my balance sheet has a contingent liability entry, and that contingent liability is the last 12 months' commission I earn, new business commission. If a new advisor comes into the industry and he has to put a contingent liability on his balance sheet, of the last 3 years commission he's earned, how do you think he's going to get capital? How's he going to borrow the money to get his business going? It's not going to happen, is it? We've got a flight to risk. Flight to risk is good, but that's financial planners starting to pick up a rate book and say, yes, I'll now sell insurance. It's trendy. We actually need new players in the market, and a 3-year responsibility period is not going to give us new players.
But Brad's point was that he started his business with hybrids.
That's still a 3-year responsibility being
still here.
Requested by the FSC, though.
Brad?
I did, John, but I would be a rarity. I've had that said of me before. I'm not sure it's a good thing. But, it really is choice in business models is really important. And I guess, you know, we hear the underinsurance stuff, and we saw some stats on it this morning, and we notionally know it's out there. But I think there's other challenges that we've got to tackle in the product world. And the underinsurance isn't just in clean skins. We have a really underdeveloped market in taking on substandard risk. We have a lack of innovation in what the product providers provide to incentivise the client to stay with the same product. So it's not just a question of price. You know, we've almost got an airline model going at the moment. A seat on an aeroplane, what's the cheapest price I can buy it at? Well, we've got to get away from that. Otherwise, we're just going to have the continual cycle down, which we see in airlines going broke all the time. We need to get to some value in the product. We need some innovation in it. We need something that brings the client to want to have this company over that company for something other than the price of the product.
Okay, we'll move now to, and we will come to questions from the floor in time, but we'll move now to one of the questions that's come in from one of our webcast viewers. And yes, John, I'm coping with this just. And that's from Matt Smith, who asked you, John, can you inform us as to the breakdown of the 13% increase in lapse rates in recent times? Could it be inflated in recent times due to the online sales market selling on price? What is the breakdown of the lapse rate?
Our best guess is it's about 50% people moving to a new policy and 50% people just walking away because they, for whatever reason, can't afford it, change of circumstance, whatever it might be. So our feeling is it's 50-50. In terms of why lapse rates might be up, I think if there is more insurance being sold, I think, and the market's expanding, and there's no, I'm not loading this question in any sense, there may be people who have bought it for the first time ever, but don't see the value in it. Big V or small v, Brad, don't see the value in it, and particularly if they lost their job or, you know, the mortgage is getting tough or whatever it might be. So I think that's what we might be seeing a bit of at this stage of the game. And if, I don't know, I mean, if you speak for the people with the, what is it, Laminex tables, Don, you know, all of those figures that Scott showed about uncertainty, if you're looking into the next couple of years and you're saving money, you're going to sit there with the insurance premium and think, you know, I don't know what's happening next year. And for all the wrong reasons, which should be, could lose my job, could get cancer, could get hit by a bus. If that happens, I ought to be looked at. I ought to be protecting my family. It's this money's better spent knocking it off the mortgage or paying off the credit cards.
Can I add to that, Mike? I think also there's a catch-up in the last year of lapse rates. I think before the GFC you had very good lapse rates. Then during the GFC they went spectacularly good as people became very afraid. So you saw lapse rates drop 2008, 2009, 2010. And I think what you've seen in the last year or so is a catch-up. So we're actually going back, I hope, to a pre-GFC long-term good lapse rate. I think in the Australian market, if you do it over a 20 or 30-year period, you're looking at unemployment hitting 10% until lapse rates get really, really dangerous, and I think that supports John's point.
The point I didn't answer in that question also, do we think it's direct? It's too early to say, but what we are seeing is in a number of, we're seeing an increasing level of cover through group policies, and you know, if people can get really, really good cover through a group policy, maybe you drop your external policy. Although that's only for a small number of people. The majority of people, I think, as Richard said, not only have very little cover under their group policy through their super, what they do have they don't even know about, and they're the ones we want to top up. They're the ones that most at risk because either they know it and they think they're covered and they're not, or they don't know at all and they have no interest.
Mike, can I just add on to that?
Yeah.
A couple of important things there. We're making some of this, or we're working our way through this policy in some ways with a little bit of a vacuum of fact. And, you know, we do need some evidence. We do need some numbers to help us arrive at the right point. I mean, if lapse rates are up, how much of it is cyclical? How much is it because the market has moved? How much of it is because the companies have got their direct offerings? How much is the ads on telly? How much is the mortgage stress? How much is it because people who don't believe in insurance we actually need some fact. Making policy in a vacuum of fact is a very, very dangerous place to be.
And just to pick up on that point, I think this morning's been very helpful. I wonder how many advisors realised that if we didn't self-regulate, that we would be regulated over the top of, and you can imagine what suboptimal result we would have got if the government had done this. We would have had 20% level, or something similar to that. They would have smashed us. So I think today's been good in sharing some of the background information to why we're going through this process.
That might be the trump card over having the time to get the fact.
Yeah, look, I'm sorry, but it still behoves upon us to challenge assumptions that are made that we don't necessarily believe in. We're told that the last 12 months' lapse rates have been a deterioration, yet Rice Crayshaw has told me that there's been an improvement in lapse rates over the last 3 years. In fact, in 2009, the industry lapse rate was 15.21%. Today it's 14.96%. In an industry that dictates and works on long term, why would you use 1 year lapse rate experience as a reason to change your remuneration model?
One of the questions that was added by our online friend is what was included in that lapse rate, and he asked whether that included TPD and other claims.
I'm sure it does. TPD as in TPT policies or claims? Policies. Or lapses because of that? No, I'm sure it doesn't include claims in that. I think
the end of a policy when a client gets to the age of 65 using extra protection expires.
that is treated as a lapse as well. Now the cohort there, the lapse rate, fair question, you've got to answer the question. So on that, if you go for cohorts of 65, so I'll pick on Clearview's direct portfolio, right, which you can say has got no advice in it. Now there are some advisors in Australia, particularly in Synchron actually, who are selling Clearview's direct products now. But in that lapse cohort around 65, the lapse rates are probably 30%. Right? If you come down to people who are 40, it's probably about 6%. So these are all averages. So when we quote, say, a 15% lapse rate for the industry, that could actually include a very large group scheme going from one company to another. Right? So there's a...
Anybody asking questions from the floor, there is a microphone. This is being webcast in deference to our people in the far-flung reaches. I'm happy to get a microphone to you when it's coming right this moment. And if you could let us know who you are.
Well, she's on fire. I can certainly hear her.
My name is Micah Suggers from Suggers & Associates. I'm a Melbourne-based advisor, so I feel up especially to be here this morning.
We're privileged to have you here.
Thank you, Simon. And I'm a new advisor to the industry, less than 3 years, so I would not be here probably if this proposal gets through, because there is no way I could have survived 3 years without taking any income from my business in that period. But I find it amazing that we're having this conversation about lapse rates. It's all about sustainability, and yet, as has been pointed out, we don't seem to have any facts or evidence about what a lapse is. We don't seem to have any facts or evidence about what proportion of those lapses are attributable to advisors and to advisors' advice in moving clients. I've got a number of examples where I've acted in the best interest of my clients in the last couple of years and changed their policies because of their situation. And if this proposal goes through, then I will be penalised for doing that.
No, you won't. No, this is critical. You won't.
But if the policy's been enforced
No. If it's the second year, right? Let's just say it's second year, and you acting on best interest, which of course will be legislated soon enough, you decide to take your client from A to B insurer for their best interest. You pay back 100% of, you pay back 75% of the premium, and you take another fully upfront premium from the new company.
But
so you're not penalised.
I'll give you an example. I've got a client who last year, the initial application I put in was rejected based on health reasons.
Yep.
So I'd done all the work and got rejected. So then shopped her around to other insurers, got her underwriting pre-assessments from about 5 different insurers, found one that was able to take her application on with a loading of 150% and with a view to, the initial insurer said they'd review the case in 12 months. So I put the cover in place for the client. This took me ages. Now 12 months has passed her health has improved. Again, I've shopped her around to a number of different insurers to make sure that I can get the right outcome for the client. I should still get paid for that work.
And you will. You'll get the full... You start again with a full commission.
But I have to pay back 100% of the commission from last year.
It was the second year you pay back 75%. You already pay back 100%. In the first year, there's no change.
But, I mean, it had to be after the first year before they would consider...
Then you pay back 75%, but you pick up another 120. You pick up 100%. You start again. The clock starts again.
I think you're illustrating, though. The issue in the market is the cost of advice, right? And this is the issue that people are going to have in the industry. So let's just learn from this. It was only 20 years ago, Don Trapnell, correct me if I'm wrong, that we actually had 2-year responsibility periods. Then a new company came into the market called Occidental, which was accidental. And they had 1-year responsibility periods. Apologies to anyone from Occidental. So these are competitive issues, and it is so important to have impact statements. And I'll just pick on FOFA. The whole purpose of FOFA, as I understood it, was to increase the independence of advice. That was the purpose of it.
And the accessibility of it.
And the accessibility of advice. The impact of FOFA will be to reduce the independence of advice and reduce the accessibility of advice. So to me, the importance of the discussion is all around impact first, and actually trying to have a fact-based conversation as opposed to a fact-free conversation. Your point is extremely valid, and we need to take into account of that, because that is about the cost of advice. We don't expect you to actually pay for all of that out of your capital base, right? But we need a mechanism.
Micah's question really is, how many times does she have to work for the same commission dollar? That was her question. How many times does she have to see a client, sit down with a client for that same one commission dollar?
But it's a different commission dollar. You get it the first time, and then you get it the second time. But you're also making the assertion, and I'm going to get screamed down by saying this, but it's a fact. You're making the assertion you have to start all over again every time. Yes, that is the case sometimes. No, it's not in other occasions. Sometimes you don't have to put as much work in the second time as you had the first. And you will disagree with me, but I disagree with you.
One of the things that Simon mentioned again there was the cost of delivering advice, and this is a really hot point. Out of this process, one of the things that we've asked John to take back to his members is what can the product providers do to help bring efficiencies to how we deliver our advice, so we have a lower unit cost to actually do our job. And obvious things like data feeds into the most common practice software management systems, Xplan for example. We don't have them. Why not? We heard from Scott before that everything's moving digital. Clients are going to expect us within 6 to 12 months to have access to that stuff online. We actually need to get that stuff feeding in to make us efficient in our practice. Then it doesn't put as much pressure on us to earn as much out of doing the work. Other things that we could look at. You know, I've got one particular client that sticks in my mind. Every time she gets about a $1,500 pay rise, she rings up to increase her income protection. I can't afford to do the time to get her the increase, but of course I have to, because we don't